Hello everybody, this is Paul doing my weekly check on everything that's going on in the market right now. So I thought I'd post an update on a pretty rough day in the market at the moment with some different things that I got going on in my portfolio, why I think the market is down, just different things. So first thing I wanted to review was my portfolio changes since the last time I did a video. You'll notice some funny meme stocks that are sitting in here right now. You might be going, Paul, are you crazy? Yeah. Um, so what I did is I threw some money back into AMC, and I threw some money back in. I threw one share into GME, and I'll explain why I did that here in a second. So you might be going, Paul, that's crazy. Why would you go into those two meme stocks? That's totally irresponsible. Well, on AMC, I actually think there's a recovery story that'll take it back up to 18 or so. This is a total guess because that's where it was before the pandemic. So I have a feeling it'll go back to around there. It's gonna swing hard between now and then. With GME, I wanted to see something. So I bought one share. I don't really care what the price is. I just wanted to see something, just to kind of, I don't know, just for information. I'll tell you what's going on here in a second with that. So if you notice, Apple's gone, and Microsoft has been dwindled down. If those are large parts of your portfolio, you're hurting right now, really bad. Although if you bought them last year when they were really low, you really don't care because you're still up probably 40 or 50% on them and don't really care. If you bought them in January, I'm sorry, because you're hurting right now really bad, and I'll explain why you're hurting. So why did I grab AMC? Why did I grab GME? And then what other portfolio things do I have going on? So this video is going to cover two things today, actually, maybe three. So first thing I wanted to cover was this little thing. If you go on E-Trade and you click on this little thing that says what we offer, they have all these little different things like cash management, fully paid lending, and all these little different things. If you click on fully paid lending, it takes you to this screen, and you go, what in God's name is a fully paid lending? So fully paid lending, if you know anything about how shorting works in the market, what shorting is, you don't actually own the stock. You borrow it from somewhere else. So where do you borrow it from? Well, you borrow it from somebody that owns it. So I tried to get into, I tried to get into this program about a year ago, and it kept saying, no, you can't get in. Maybe I didn't have enough money or whatever, but I was able to get in. So now that I'm in, I grabbed two stocks that I'm relatively sure will qualify pretty easily for this program that are heavily shorted, that are in high demand. So what is the what's going on? So when they borrow your share, and it's shorted, they're also paying an interest rate on the way that it works. Like they pay an interest rate to it's kind of like they have to put up a certain amount, and there's an interest rate associated with that. Well, the way that it works is the person who owns the shares gets part of that interest rate. So the way to figure out if you're getting how this works, what everything's going on, when they borrow your shares, at least on E-Trade, one guy had a video with Webull where he kind of did it on the app and he went through the same thing. I had to call E-Trade today to figure out where the screen was. So if they borrow my shares, if somebody borrows my shares because they're shorting, it's actually going to appear here: date, symbol, quantity on loan, like how much they have, pulled out, their collateral accrued in, and you actually get paid money every single day. They actually pay, I think, middle of the month. Some people were saying. I'm gonna have to see how it works. So what I did is, so I grabbed AMC because I actually kind of think it'll actually go up just by itself if I hold it long enough. And then also, I grabbed one share of GME because I know that is irresistible to shorts right now. So the chances of that screen that I was just on is going to update is pretty conclusive. When it does update, if it's GME especially, I'll post a screenshot just to see, just to post it on Twitter, so people have information about kind of how much people are willing to pay to short GME right now. I'm wondering if AMC is going to get pulled into that. When I applied for this program, I actually didn't own either of these two stocks. So there must be something else on my list that's attractive to the shorts I have a feeling it might be this guy right here, or it could be any of these other ones, maybe IBM. You never know. So if that updates, I'm definitely going to put that in a video. And then if I actually get any, when I get any payments from it, I'll let you guys know. The more shorted the stock is, like the more demand the stock is to be shorted, the higher that you actually get paid. So we'll have to figure out. A lot of the videos on YouTube, it was from last year, and it was like I&O Pharmaceutical. That was one of the competitors for the vaccine, and that was a really big stock that people were buying, and like a lot of people were shorting at the time. So we'll have to see how that goes. So another stock I jumped into, or another ETF. You might be saying, Paul, well, you just pulled out of Apple, and then you just also pulled back your position in Microsoft. I see you have QYLD. And if you know anything about QYLD, I had a whole conversation with a guy on YouTube about this. So looking at QYLD. So first thing you notice about QYLD is it's an ETF. And it's a very specific kind of ETF. So it says NASDAQ 100 covered call. So what that means is if you looked at this title right here, you would think that this entire ETF is nothing but calls. So that means like options. So they're not on. So if you just read this title, you would think all they do is buy calls for the future and then pray that the NASDAQ 100 will go up so that they can keep paying. And apparently it's a monthly dividend. So you read that. Okay, so the first thing you look at is you see this little thing right here. So you see this dividend amount, like 11%, like wow. And then you see this right here, 0.2, like that's almost as much as O pays, right? And it's at 1/4 of the cost. So what is going on? So I'm going to explain QYLD and how you can figure out what's going on in the future if you ever see anything like this. So the first thing you look for is make sure that they have like assets that they've been managing. Second thing you go to is you go to the charts. And you pull this thing back as far as the fund has existed, and you do this. First thing you kind of do is you look at 1 year. Okay, are they consistent? Consistent. They're actually raising their dividend. So, let's pull back 10 years. And then the next thing you look for, was it all of a sudden at $300 a share, and then all of a sudden it's like nothing, and then all of a sudden the dividend's going down. So what you do is you start going through here, and you click through, and you kind of see, have they been consistent? Have they ever stopped for long periods of time? Because then, you buy it, and all of a sudden they stop, and then you're like, well, I just got screwed. So all of a sudden you see dividends definitely moved around, but it's in that 10 to 23 cent range, and it goes through cycles. So, and if you notice here, right here at the top part right here, it tells you that it's always been in a range between basically the lowest point it's ever been at was right here, $17, and it's always been in this range of 17 to 25, and the dividend's been consistent the entire time in some range. So, well, that's weird. If they only bet on the NASDAQ going up, as this name suggests, well, of course, a call means that you think it's going to go up. You're betting for, stocks only go up, right? So all of a sudden you see when it has a really bad day, you would think the thing should tank. You would think, as everybody literally pulls their money out. Well, what in God's name is going on? And especially their dividend should tank, without a doubt. All right, so what's going on? So when you go over to portfolio of any of these brokerages, you're going to get this little thing in their top 10 holdings. Well, all of a sudden you start looking at this and you realize they hold stock. And it tells you what percent of their fund is holding stocks. 9%, 9%, 12%. Okay, so it's an ETF that holds stocks. So it's tracking the index. Well, that's not what this says. This says covered calls. And then all of a sudden you go down to this part right here and you see it says bonds. I don't know why it says bonds. But I guess it's just where E-Trade could figure out the best way to put it. And you see this right here. This is all a complicated way of saying they have calls that probably expire next month. But these are basically just covered calls. That's all it is. It's a lot of them. It's quite a bit. So, and then the cost basis is weird just because of how E-Trade displays it. But they don't have $62 trillion worth of calls. That would be insane. So you're asking yourself, well, okay, what's really going on here? So to figure that out, I'm going to show you how to read a prospectus. You can go to Morningstar. Seeking Alpha should have this if they're, they should have this. It's called a prospectus. You have a fund report, which is typically what comes from your broker. It has like a little tiny stupid breakdown that's really useless because it's literally all this information just over again with somebody's opinion written in there, what they think is going to go on. Prospectus is actually what really tells you what's going on, and why you need to learn how to read these things is if you do ETFs, you need to know what you're investing in because these names suck, and then they really are horrible. So what you normally do is you click on the annual report. You can click on the semi-annual report too, and you're going to find something like this. It's normally an asset management company or a company that manages assets, ETFs. They always have their cute little name in front of it. So Vanguard has a ton of these. So the first thing you do is you find, and these reports are typically some stupid long amount, like they're just a lot of pages. So what you do is you find yours. So this one is called Global X NASDAQ 100 Covered Calls. So you find it. This guy right there, Covered Call ETF. And you can even look it up by that, but what I do is I do this. I just hit Control C to copy. Now I hit Control F to find, and you just start going down. And then you find out that everything that you want to know is on page 87. I know this already because I've already been through this. But, alright, so we got to find it. These things are really long, and I'll show you why they're really long. You need to learn how, if you're investing in ETFs and that's all you do, you need to learn how to read these. Let's see where we're at. It's around here somewhere. Here it is. Okay, so it starts on this page, which is page 91, and you can see the same information. This is actually goes through Morningstar, to be honest with you. E-Trade links directly to Morningstar. So what you're looking at is it tells you what's going on. So basically it says in common stock, 97% of this fund is invested in stocks. Okay? Straight up, they own shares. There's the value amount of the shares whenever this report was issued. Does that look like what's going on? No. So you go down and you're going to see what's going on. They give you extreme breakdowns. They tell you specifically what stocks they own, all of this. If you ever look at any foreign international ones, they all look like this. They tell you what companies they're invested in. They tell you what percent. They're required to issue these. There's a reason why you need to learn how to read these, because you can get screwed. Because especially if you go through them and you just see a bunch of like very shady companies, you might want to get out of there. And if they don't have a prospectus, if it's some weird one, AWF is a good example of that. This one right here is one that I had. You actually have to go to their website, and they tell you on their website what they're invested in. That's private equity. So any of these private equity companies, you just go to their website and you find this, and it'll tell you specifically. It looks just like this, but it's on their website instead. ETFs have to issue these. These things that are basically private equity funds, if you click on that, you look for a prospectus, you're not going to find it, I don't think. I wasn't able to find it. So anyways, here's what else is going on. So basically, this is down to the end of the stock page, and it tells you specifically how much of this fund is basically tracking this. See that right there? So what you can expect is when you have a down day like this, the fund is going to be down because it tracks that. What is also going on is this. So what does that mean? And remember, this is the annual report. So premiums received for all of 2020, I believe this is for. I got to look at the year, but was 49 million. There's also, and then this is also what the contract was at the time, because it was issued in October, so this is what they actually had written at the time. So that's what they have to report on this annual report. So you're asking, what does all this mean? What that means is that 97% of this fund is backed by stock. 3% of this fund, or well, actually 0.5% of this fund, is backed by covered call options. So basically betting on the market always going up. You might be asking yourself, well, what happens if the market doesn't go up? What happens to the fund? There's a few things that can go on here. You would see something like this. So you see how it starts at 26 and then it goes down, then it goes down, and then all of a sudden everybody's getting happy again, everybody loves the market again. As the premiums from the covered call options pay out, so if you're having positive months in the market, these are paying out. Well, you might be asking, well, okay, well, then these guys are paying a really high dividend. How in the world are they doing it? So you go down, keep going. These things have the financial breakdowns of everything. So let's keep going. You get to this page, and you have to kind of search through these. This is like tax information. So basically, you see this right here? This whole little section right down to there is telling you what's going on. All right, so ordinary income is the premiums that the covered calls are paying. If you look at 2019, it was $40 million. If you look at 2020, it says 2.8 million. And then if you look at some other things that are going on, so in 2019, you see it was long-term capital gain. That means they sold some stocks and made some profit. Then they have return of capital. You see this word right here? You have to learn what this word is. This is why you don't touch these things until you know what's going on. Return of capital means they're literally returning your money to you. Hope that makes sense. Some people have called that a Ponzi scheme. It's legal. They're literally just giving you your money back in a weird way. So, yeah. So for 2020, if you look at it, the return of capital, where's it at? Covered call ETF. Where's this guy at? It's right there. So this is how they pay the premiums this is how they pay the dividend every month. See, off of that number right there. That is, so if for 1 year, whenever you look at this on your tax form, it might show that a majority of your money that paid out through this fund was through dividends and long-term capital, okay? But some months or some years, it might show that a majority of the money that paid back was through this return of capital. What that means is that it's treated differently on your taxes by a little bit. If it's return of capital, you don't get taxed on it, I don't believe. I have to go check that, but you might want to verify that. So that's kind of why you have to kind of know what's going on with these funds. Whenever you look at them, you have to know how to read a prospectus. If you look at enough of these things, you just know where to click through. And like I said, it's easy if you just put it in like Control F, stick in the name of it, and whatever screen that this pops up on, just read that screen and see what's going on. It tells you what's going on for short-term losses. So you might be asking yourself, well, why didn't the fund just pay out premiums all year? Well, what happened in March? If you only bet that the market was going to go up and you had a ton of your fund, or like a good bit of money in your fund invested that the market was only going to go up, well, all of a sudden the market tanks by 50% in March, there you go. You take a huge loss. But if you bet that the market was going to go back up, well, all of a sudden it's earning money again, and they can distribute. And this is a long-term loss, so that means that they actually sold stocks that started to tank. They did it across all of their funds too. It's not just one fund that they did it. So that's another thing that you can see when they stick them all on the same page like this. You can see what they did across all of their funds. If they treated one fund special or something like that, and you can see kind of, if you know how to read financials, I really strongly suggest that you start learning how to read prospectuses. I've seen a lot of bad information on YouTube when it comes to these kind of funds. Just people just saying stuff that makes no sense. One guy I was reading through, he had a whole video devoted basically saying that the only thing that was in this fund was call options. That's not correct. They went through it sounded like a very professional video, but then when you actually look at the perspective, you learn that literally 30 minutes worth of a video was complete misinformation. So, and the reason why I knew that video was complete misinformation is because if this fund had nothing but call options in it, it would be bankrupt right now. Because if up till February you bet that the market was only going to go up, and then all of a sudden the market went down by 50%, your fund would be completely cut in half. This thing went from $23 to $17. And what was also kind of strange about it, and why I started digging into it deeper, is if the fund was nothing but call options, I promise you right now they would not have been paying out a dividend, or else this fund would have been a complete scam, and I would not even touch it. So now that you have a general idea what's going on there, like I said, it's one of those things where you just have to go through it, and just learn how to read a prospectus. Like I said, this is where it's at on E-Trade. You go to portfolio, you click on prospectus, there you go. Or you can go straight to Morningstar itself, click, find the ticker, and it's on there. It's under, I think there's like a whole little thing that says reports. You just click the report and it pulls it up. It looks just like this. Semi-annual reports look identical. It's just there for a shorter period of time. So you're not really, this one was, the last one was April 2020. I like this one right here because it was actually the latest, so October 31st, 2020. That's actually a pretty good. They haven't made major moves since then, since the market's been going up. I strongly suggest learning how to read a prospectus, just especially if you mess with ETFs, because you'll learn what's. So if you learn, I don't know. Here's another one. If you want to know another one, if you ever wanted to invest in Japan, for example, this is EWJ. Same thing. Go right here. Go to the prospectus. So the only thing you know about this fund is that iShares Inc., iShares MSCI Japan. You have no idea what that means. You just know it says Japan. So same thing. Find it, and you see how they have a whole bunch. It's actually how you can find other funds that if you're looking for specific funds, by the way. Find it. Click on through until you find it. It's in here somewhere. There's 8 out of 10 matches. Is this right? Where's the thing? I thought it was a breakdown. It's somewhere on here. I clicked the wrong thing. Or maybe it's on their semi-annual. Is it on their semi-annual? Well, in theory, they're all supposed to list them out the same way. I know I've looked at this one before. Just look for the word Japan. Here it is. There we go. I don't know why it took so long. Anyways, here it is. It's on their semi-annual. I don't know why it's not on their annual report. That's just probably something that iShares does. I guarantee if you look at any of these other iShares ones, they all look the same. They're all reported on their semi-annual. So literally, same thing, right? So if you look at it, number of shares, amount that they have invested, the name of the companies. Pretty much what's going on. If you look at a China ETF, probably the same thing. I don't know. But I was in this one for a little bit because I wanted some exposure to Japan, and I got out of it because dividend kind of sucks on it compared to where I could have had my money being more, if you look at this one, I don't even know where the dividend's at. And I think that's every 3 months is 25 cents. What is that? December and then June. What? Guys are crazy. Yeah, this one's biannual. I think it only pays a dividend every 6 months. But hey, if you bought it back here, you wrote it up to here, there you go. Yeah, you'll notice this sometimes happens whenever people think the U.S. markets are going to tank. So if you look right here, it's at 50, it's at, 41? If you wrote it up to 69, there you go. And it pays a biannual dividend, so I guess there's that. That's just because of how companies outside of the U.S. do it. I am not sure how that one's taxed. I have to actually go look at my taxes to see how I got taxed. I don't even think I got paid a dividend on that. So I'm not even sure. But you have to kind of look at that. You might actually get taxed at American tax rates because it's an American company that owns the Japanese stocks. I don't know. You don't actually physically own the stocks. You own the ETF. So I would assume it gets taxed like an ETF. So you get the normal capital or the dividend tax rate. And then also the normal long-term capital or gain rate and all that stuff. You got to kind of look into that. But, so here's my portfolio there. Here's the number that's going on there. I wish I could keep putting a magic number on here to make it look like it's going up even though the market's tanking. That would be cool. I should do like some other YouTubers do. Just only post videos whenever it goes up. So even though I have a day where it's like 600 down or something like that, I should be like, oh, look, I got 45,000 in my account now magically because I'm such a great investor. So what else is going on? Why is the market tanking right now? Very simple. This is why you have to learn why everybody. It's kind of funny. I saw a YouTuber yesterday say they don't care what happens in the bond market, well, and that they were going heavy into tech. Well, okay, tell me how that works out for you. Next has lost all of its gains for the entire year right now. Um, I really pity that guy. I hope he makes a video so I can see how far his account's down. But like what's going on? So basically, here's what's going on. The bond market basically thinks that we're going to have, well, you have two things going on. So the the economy is starting to open back up, or everybody's thinking the economy is going to boom. If you listen to any of the business networks, you would think we're just going to have the biggest boom ever. Like it's going to be like the economy's going to be great, everything's going to be great. So that's causing two things. What's that causing is basically everything that went up because of COVID is now going down because COVID's going bye bye. And it, today's a bad day to look at it, but yesterday was a really good day to look at it because it was basically, I guess you can kind of look at it because the Dow's only down 1.75%, but all of a sudden the Nasdaq's down 3.52%. Basically, what's going on? Rates go up, so you have a lot of things that are going on. So everything that went down because of COVID is now going back up. But one thing that did go down was rates went down to rock bottom zero. So that's why the housing market has been doing really, really well compared to the rest of the market. So what's going on is as rates come back up, because everybody's pulling money out, and they're being forced to pull money out. This isn't voluntary. If there's an actual like technical reason what's going on right now. So the money is being pulled out of there, so rates are going up. Because one thing, they're expecting inflation, because all of a sudden, everybody's going to have a job again, right? So they're expecting inflation. So this is going to go back, in theory, this is going to go back to where it was prior to the pandemic. Pretty much everything is reversing right now, which is why everything that went up, people staying at home watching Disney, right? So now all of a sudden everybody's like, oh, well, they're not going to stay at home and watch Disney anymore, and they're going to go back to the parks or something like that. Well, the parks still aren't open. Oh boy, Disney's going to suffer. Apple, for example. Anything that profited is going to get hit. I am not sure how much longer this goes on. This right here, all this right here does not stop until this stops. All of this. And one thing you also see is going on, you can actually tell, all the bonds are going back, all the bond prices are going back up to where they were pre-coronavirus. Oil, going back to where it was pre-coronavirus. Everything's literally reversing right now. It's just going in a big reversal cycle. Home Depot yesterday was a good example of that. Even though they blew away their earnings, well, nobody cares, right? Because they think, well, Home Depot really benefited because of the virus. Well, not really. Home Depot was doing 20% returns every year before that. But because it went up a little bit more during the virus, everybody thinks, oh, well, no, Home Depot is going to go down, so it has to go down. I actually added Home Depot, by the way. I forgot to mention that. Part of that Apple that I sold, I added Home Depot. Down 74 on it. Really don't care. Because first of all, I caught the ex-dividend date, so I'll get paid their dividend. And then also, without a doubt, Home Depot is going to go back up. This is one of those ones you can hold till hell freezes over. I already know I'm going to hold that one forever. The only reason I wasn't holding it before is because I just didn't buy it in enough quantity. I don't know. That and I made a huge profit on it because I wrote it from a much lower price. You can also see something else that's going on. Look at the banks. This is the same thing. Rates going up. This is actually a good thing. This is what's supposed to happen. This is supposed to be lower than that, not the other way around. Those two things go down, that means your banks go down because your banks make profit. They borrow on the short end and lend on the long end. Or is it the other way around? I don't know. Are they borrow at the long end? I forgot how it was. Yeah, I think it is. Yeah. So basically, they borrow on the short end, lend at the long end. So this is how this is supposed to be. This is actually a healthy thing for an economy. This is really healthy because these aren't supposed to be close to negative. That's really, really bad. That kills your banking sector. Just go ask Europe what's going on right now with their stuff. They're literally starting to admit that negative rates was a horrible idea. because their banks are just struggling, been struggling, have never recovered. Their banks have never recovered from 2008, which is why when this happened, they had to be bailed out yet again. So, yeah, because the banks had to make some really risky trades, and they made a bunch of risky trades, and they had to get bailed out again. Nearly took the whole world market with it. Um, when our markets were collapsing, if you look at all the guys on Twitter, they were watching European banks. A lot of those smart, really smart guys that post on Twitter, they were watching European banks. So you have to watch the bond market. When this stabilizes, this whole situation will stabilize. Until that happens, it's not gonna happen. Um, if this doesn't slow down, I promise you right now, you'll hear the Fed. The Fed controls this by, um, yeah, the Fed can control this because they can just come out and just all of this money that's being issued into these markets. So this was an example right here. See the 5-year? They issued a bunch of debt right at the 5 and the 7-year today. Um, it didn't have a lot of buyers. So all of a sudden you saw rates spike hard right here. This right here, a 20 basis point move in a day is a freaking lot. When all of this went down originally, if you go to the thing, if you just go there, you know, this drop right here, when all of this happened, if you actually scroll down your screen and look down on the CNBC thing here, these were dropping like a rock. Just dropping. Because the Fed instantly went to zero. And then they just kept going down, 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 down. And they actually went negative for like, I think 5 seconds or something like that, which they're not even supposed to be able to do. Unless the Fed says it's okay. There was actually a negative right here in front of, I want to say in front of the 3-month. It went down to negative. See this negative right here? That's Europe. But you have to watch bonds. I mean, bonds just dictate the market. I don't care what anybody says. You just have to know what's going on because this is what happens. You all of a sudden decide, oh, I'm going to make a huge bet on the NASDAQ at the beginning of the week when bonds are going up by 20 basis points a day. It's going to hammer the NASDAQ because they rely heavily, because they're growth companies, right? So their earnings don't keep up with their growth. So how do you keep up with their growth? You borrow a stupid amount of money. You know, that's why you look at, I mean, the most notorious example of that is Tesla, which where's it at? This is after hours, but if you're wondering why Tesla's tanking, this is it. This is it. This is what it's rated at for its forward price of earnings. To get bigger and to grow the company, they took out a lot of debt. Well, to take out a lot of debt, you know, you have to borrow, right? Well, if borrowing's really low, you can just crank out, you know, things on debt. You can offer a bunch of programs to people like, you know, oh, instead of charging $30,000 for the Model 3, I'm going to charge $20,000. You know, just you can keep lowering price, you can offer incentives and take losses because the amount to borrow isn't that much. What this also does, when these prices go up, they start to compete, and this is a screen I haven't clicked on in forever. I had old videos about this actually, where I was explaining what's going on. This is the corporate debt market. These are the U.S. Treasuries, the yields. You go buy a bond. This is literally just bond, okay? If your credit rating is really good, you get a lower rate as a company. If your credit really, really crap, you get a lower rate. You get into the triple B and all that. A lot of U.S. companies are down here in the BB range. Like J&J, Microsoft are sitting in the A range, but that's really about it. Our corporate debt America is really bad at finances. But rates are so low, they don't care. So what's going on is, okay, well, if all of a sudden a government bond, is giving me a better yield than a AAA or almost where is it at? You know, if a government bond is all of a sudden giving me a better yield than Apple's bond, well, I'm going to buy the government bond. This is actually, where's my better example at? Here's high yield. Or no. I don't even think this is updated yet. I gotta see if this is updated. It might have updated. So this is a AAA, for example. So this is why Apple would be getting hit. If you see, whenever they issue debt, they really issue it in these different ranges. And you have to decide, do I want a U.S. government bond that I know is going to pay out, or do I want an Apple bond that might not pay out someday? And these are really, really long-term decisions. We're talking very serious money makes these type of decisions. And these little tiny percents, these little itty-bitty tiny percent changes, these percent changes right here, make a big difference when it comes to these. Because if you can't issue debt to keep adding, if you can't issue corporate debt at the rate that you want to rate, well, you got to pay more. Well, you barely have earnings as it is. That's the problem. So that's why you see just the entire, and especially Tesla is vulnerable. Tesla is massively vulnerable to this right now. Low rates, they're going to go through the roof. They're going to go through the roof several times over. High rates, then you better start posting some profits to back up that debt, because they're still a heavily indebted company. There's other companies too, just any of these like Lamb, it's just any of these companies that just have a lot of exposure to debt. They need to issue a lot of debt to keep their stuff going. And then also what happens, there's another thing that goes on. See this little what we offer thing? It's somewhere in here, I thought. The people that trade on margin. Well, you have to pay your broker a margin rate, right? Like an interest rate for your margin that they charge you every month. Well, guess where that gets determined? Down here. Because your broker is effectively lending you money to go bet on if the market's going to go up or down. Well, here you go. This is where they get that interest rate from. They definitely tack on a lot to it. Some brokers don't charge that much for margin, but some do. So when this all starts to go up, well, all of a sudden the people that like to borrow on margin to just pile into growth stocks, well, all of a sudden that becomes way more expensive. So that's kind of what's going on. And then you got GME and you got AMC mooning again. I have no idea what they're going to do. Like I said, I literally bought them. I bought AMC kind of because I think it might go up. And I'm not even really convinced of that. But I bought GME just literally to go to their screen and to see what this is going to say. If you follow me on Twitter, you'll see. I mean, we're going to find out together what it does. I would love to see if I can get some just extra income from that. That'd be hilarious to me. We'll go to there. If I ever see the market going down again, what do I dump? Probably, what's the easiest thing for me to dump? This guy right here, the QYLD guy. Actually, I might not dump that. I don't know what I'll do. If it ever goes down to 17 again, I'll buy a bunch of it. Now that I know that in like the worst crash in like forever, it only went down to 17. I mean, obviously AMC I would dump out of. GME I would dump out of. The rest of this I'm just going to hold. A lot of this is going to be long-term holdings. I don't see anything moving anytime soon, even if the market tanks. And like I said, last video, once I get the tax return, I might add Apple. I don't know where it's at. If it get into a good price, it's actually, it's in the 120 range. I think I posted on Twitter, if I said I saw it go into the 103 range, I would actually buy it again. The ex-dividend date isn't anytime soon, so I actually have time to decide if I want to buy this. But, I mean, in the long term, where do I think Apple's going to go? It's probably going to go to 400 again. I mean, it's Apple. Like, what? I don't know. I think it's going to go up again, but I'm going to wait for all of this to be done with the insanity. Another time that you're going to see this happen, by the way, this is why you need to pay attention to the bond market, despite what the idiots on YouTube tell you. So if you get this $1.9 trillion stimulus, they have to issue all that debt, right? Well, these are going to go up, right? That's what's going on literally right now. Also, the economy's recovering, so that's why this is going up. Another thing, if all of a sudden the Democrats are like, okay, we're going to do an infrastructure bill, that's another $2 trillion. Guess where these rates are going to go? They're going to go up again. Guess what's going to suffer again? This again. So later on this year, when the Democrats can do reconciliation again, if they do decide to do an infrastructure bill, get ready, because NASDAQ's going to go for another ride later on this year. I would bet. I'd probably put money on it that if the Fed allows these to do what they're doing right now, next or later on this year, you'll see this again. You'll see this kind of wackiness go on, and watch it happen around September or October. So, yeah, we'll have to see how it goes. But, yeah, like I said, I know I talked about a lot in this kind of video, so definitely let me know what you think, okay?